$2 billion burned in 90 days. Uber's CTO just admitted their entire 2026 AI R&D budget is gone. Most tech workers don't realize this hits their wallet directly. If you're holding Uber stock or RSU grants that vest over 4 years, this confession just shifted the calculus on your total compensation. You could be looking at $20,000 to $50,000 in eroded equity value, and you won't see it coming until the next earnings cycle reprices the stock downward. Here's what happened. Uber's chief technology officer disclosed that the company burned through its full annual AI R&D allocation in the first quarter alone. No revenue offset was disclosed. No product-market fit milestone was announced. Just gone. This is the kind of capital efficiency confession that makes Wall Street nervous, and it signals a broader pattern across big tech. If your employer is doing the same thing quietly, your equity package is silently decaying. Let's be clear on the math. A mid-career engineer at a major tech firm typically earns $150,000 base salary plus $50,000 in annual RSU grants vesting over 4 years. That RSU tranche accounts for 25% of your total compensation. Now imagine your employer's stock drops 15% because market analysts recalculate the company's AI spending trajectory and see no return on investment. That $50,000 annual grant tranche just became worth $42,500. Multiply that across 4 years of vesting. $200,000 drops to $170,000. That's $30,000 lifetime gap, and that assumes just a 15% decline. History shows failed AI initiatives trigger 20-25% corrections. Why is this happening now? Because the market is finally asking the question Uber's CTO answered by accident. Are we actually measuring AI R&D ROI, or are we just spending because competitors are spending? Research shows that across the Fortune 500, AI R&D spending has tripled since 2022, but revenue attribution remains fuzzy. Google's AI infrastructure costs are climbing faster than advertised AI product revenue. Meta is burning billions on the metaverse. OpenAI has a $4 billion annual run rate, but profitable unit economics are not yet public. The pattern is clear. Capital is moving fast, but discipline is lagging. For tech workers, this creates 3 immediate warning signs to watch at your own employer. First, your company announces major AI initiatives, but doesn't tie them to a specific product launch or revenue target in the same quarter. Second, your company's R&D spend grows faster than its revenue. A ratio that used to signal health is now a yellow flag. Third, your CTO or VP of engineering stops talking about ROI in earnings calls and pivots to talking about moats or optionality. That language shift means they've stopped measuring. So what do? Start with your next compensation conversation. When you negotiate, ask for more cash and less RSU allocation. Not because you hate your employer, but because concentrated equity risk is real, and Wall Street is re-rating tech stocks based on AI spend accountability. A 60-40 split, 60% stock, 40% cash, feels generous in a bull market, but it's a liability if capital allocation gets questioned. Shift that to 50-50 or even 40-60 in favor of cash. Your employer will negotiate. It saves them cash flow, and you reduce concentration risk. Second, monitor your company's Q2 and Q3 earnings calls. Listen for specific R&D spend callouts and revenue attribution. If leadership talks about AI but doesn't connect it to quarterly revenue growth, that's a signal your stock is vulnerable. Third, diversify outside your employer. Don't let your net worth get trapped in company equity. If you have a $500,000 portfolio and $250,000 is company stock, you're one bad earnings call away from real damage. Uber's CTO confession is not an anomaly. It's a data point that signals the market is finally tightening the screws on tech capital efficiency. Your employer's next earnings call might reveal the same pattern. The key is to see it coming and adjust your compensation.